Chapter 1. No one's crazy. A man asked his neighbor, "Why do you keep buying lottery tickets?" And she said, "It's the only time I feel hope." Money choices often look wild from the outside, but inside someone's world, they make perfect sense. If you grew up during a recession, you might fear stocks forever. If you didn't, you might think they're always safe. When John F. Kennedy was asked about the Great Depression, he said, "I have no first-hand knowledge." Why? Because his family got richer during it. While others stood in breadlines, his dad hired more gardeners just to help others out. Same era, two totally different lives. Some call lottery buyers foolish, but to many, a ticket is a tiny escape, a shot at a life they never had. Everyone builds their money habits from personal history. That history is full of bias, luck, and chance. So before judging anyone's financial decisions, ask, what have they lived through that I haven't? Because when it comes to money, no one's crazy, just different. Chapter 2. Luck and Risk. Bill Gates had talent, but he also had a rare chance. His school had a computer in 1968. His best friend, Kent Evans, was just as smart, but he died in a climbing accident before graduation. One became the richest man on earth. The other never got the chance. That's luck and risk. Same force, same strength, just different outcomes. Success isn't always skill. Failure isn't always stupidity. Rockefeller and Vanderbilt broke laws to build empires. If they got caught, history would call them crooks. The line between bold and reckless is thin. Often, you only see it later. So don't worship winners too much, and don't shame losers too fast. The smarter move? Study what works often, not what worked once. And remember, luck may have helped you win. Risk can still take it all back. Chapter 3. Never enough. Rajat Gupta had $100 million, but when he stand next to billionaires made him feel poor, so he risked everything to become richer. He went to prison. Bernie Madoff ran a real business. He was rich, respected, untouchable. Still, he lied to get more. He lost it all and destroyed lives along the way. They had what they needed, but they risked it for what they didn't. Warren Buffett said, "To make money you don't need by risking what you do need, that's just foolish." Here's the truth. The goalpost always moves. You'll never win the game if you don't stop chasing. Enough doesn't mean weak, it means wise. There are things you never trade: your name, your freedom, your family. Protect them, because no gain is worth the loss of what can't be replaced. Chapter 4. Confounding compounding. Warren Buffett made 99% of his wealth after age 50, not by chasing wild bets, not by winning the lottery, but by doing one simple thing: letting his money grow. For 75 years, if he started at 30 and stopped at 60, he'd be worth $11.9 million. Still impressive, but nowhere near $84 billion. Now compare him to Jim Simons, one of the best investors ever. His returns were triple Buffett's, but he started late and stopped early. He ended up with less money. Why? Because compounding isn't about how much. It's about how long. Think snow. One cold summer doesn't cause an ice age. But year after year of small leftover snow, that builds glaciers. Don't aim for the biggest win. Aim for steady wins, over and over. Wealth isn't built fast. It's built quietly. Then it grows like crazy when you're not looking. Chapter 5. Getting wealthy versus staying wealthy. In 1929, Jesse Livermore made millions shorting the stock market. Abraham Germansky lost everything. But years later, Livermore also lost it all. Why? Because getting rich and staying rich need opposite mindsets. To get rich, you take risks. To stay rich, you avoid them. Warren Buffett didn't panic in crashes, didn't borrow too much, didn't quit. He played the long game. That's why compounding worked for him. His old partner Rick Guerin rushed in with borrowed money. One downturn, and he was forced to sell his shares. To Buffett, same skill, different mindset, different ending. At Sequoia Capital, Michael Moritz once said, "We've always been afraid of going out of business. That fear keeps you alive." The lesson? Plan for things not going to plan. Be bold in vision, paranoid in defense. Because the real secret isn't just growing money, it's surviving long enough to keep it. Chapter 6. Tails, you win. Ever heard of Heinz Berggruen? He bought tons of art. Most was worthless, but one Picasso paid for all the rest. That's how wealth works. It's not built evenly. It's built on a few rare wins. In venture capital, 65% of startups fail, just only 0.5% return over 50 times. That tiny group drives all the gains. In the stock market, 7% of companies created nearly all the profits. The rest? Mostly losers. This is called a long tail. A few outliers make all the difference. Jeff Bezos said Amazon is working on bigger failures. Why? Because big wins hide inside big risks. Don't fear small losses. They're part of the plan. What matters is how you act when the rare chance comes. That's when wealth is made. And once you build it, the next question is, what's it really for? Chapter 7. Freedom. The author, during his internship as an investment banker in Wall Street, he loved the work, but every day, someone else controlled his schedule. He was rich in opportunity, but poor in freedom. He was miserable. That's the real power of money. Not cars, not watches. It's get back the control of your time. Sick? You can rest. Laid off? You can wait for the right job. Tired of your boss? You can walk away. Freedom means saying no without fear. It means working because you want to, not because you have to. Psychologists say happiness doesn't come from wealth itself. It comes from autonomy, the ability to choose your day. Since the 1950s, Americans got richer, but not happier, because we traded control for consumption. We bought more stuff but lost more time. If you want real wealth, don't buy admiration, buy freedom. It's the only thing that truly pays off. Chapter 8. Man in the Car Paradox. Have you ever dreamed yourself owning one of these cars? Lambos, Bentleys, Ferraris. But here's the truth. No one admired the driver. They imagined themselves driving it. That's the man in the car paradox. You think wealth gets you respect, but people aren't thinking about you. They're thinking about themselves. You buy a flashy watch. They wonder how it'd look on their wrist. You flex online. They scroll past or want the same flex. We chase admiration with money, but we rarely get it. Because status doesn't make people like you. Humility does. Kindness does. Being decent does. So before spending to impress someone, ask yourself, will this really make people respect me, or just want my stuff? Because the goal isn't to look rich. It's to be someone others admire for who you are. Chapter 9. Wealth is what you don't see. He drove a beat-up car, wore old clothes, worked as a janitor. When Ronald Reagan died, he left behind $8 million. No one saw it coming, because wealth is invisible. Wealth isn't cars, watches, or vacations. It's the money you didn't spend. A $100,000 car shows you're rich. A $500,000 investment account doesn't show it all. Being rich is income. Being wealthy is savings. One is loud, the other is silent. Wealth means freedom, options, time, and security. It grows quietly, by spending less than you earn. It's like going to the gym. Exercising hard is rich. Burning more than you eat, that's wealth. But most people miss this. Why? Because we learn by watching. And real wealth can't be seen. You see the mansion, not the mortgage. You see the Rolex, not the credit card debt. You see the rich lifestyle, not the savings account. So, when you feel behind, remember, you can't compare what others hide. Real wealth is built in silence. Chapter 10. Save money. Wealth isn't built by income alone. It's built by what you don't spend. Your savings rate matters more than your salary, more than your investment returns, because savings are in your control. The market isn't, your boss isn't, but only your choices. Want to build wealth? Learn to need less. A smaller lifestyle means a bigger gap between what you earn and spend. Spending often comes from ego. We try to match our income, but humility saves more money than a raise ever could. You don't need a reason to save. You just need to. Cash gives you freedom, flexibility, peace. It's your safety net, your backup plan, your way out when things go wrong. And that return, take back the control of your time, is worth more than any stock can offer. Chapter 11. Reasonable, greater than rational. Don't aim to be perfectly rational with money. Aim to be pretty reasonable. One doctor, Julius Wagner Jauregg, won a Nobel Prize for curing syphilis. His method? Malariotherapy. He gave patients malaria. The fever killed the infection. It worked, but patients were not interested. Why? Because it felt awful. People go to doctors to stop hurting, not to suffer more, even if it helps. That's the difference between rational and reasonable. Same goes for money. Some strategies make sense on paper, but feel terrible in real life, like using 2 times leverage in your 20s. Sure, it might lead to higher returns, but one bad year could wipe you out. Even Harry Markowitz, the guy who created modern portfolio theory, didn't follow his own model. He split his money 50-50, just to avoid future regret. If a strategy feels unbearable, you won't stick to it, and quitting breaks compounding. Remember, good greater than perfect, reasonable greater than rational. Chapter 12. Surprise. Things that have never happened before happen all the time. That's what a Stanford professor said. And in investing, it's painfully true. We act like history is a map, but it's more like a foggy mirror. The Great Depression, World War II, 9/11, the 2008 crash. None of us know before it happened, but they changed everything. If you only plan for what's happened before, you'll miss what matters most. the big surprises. And even when history does repeat, the world around it has changed. We've seen 401ks replace pensions. Tech reshaped the S&P 500. Startups funded by venture capitalists instead of banks. Even Benjamin Graham, the father of value investing, ripped up his own rules because he knew markets evolve, and what worked yesterday might not work tomorrow. So if history's not enough to guide us, how do we prepare? By making space for the unknown. Chapter 13. Room for error. Smart investors don't just plan to win, they plan to not lose. That's called room for error. It's the space between what might happen and what must happen for you to survive. Think of a blackjack card counter. They play the odds, not certainties, but they never bet so much they can't afford a loss. That's the whole point. Stay in the game. Benjamin Graham said, "Build a plan that doesn't need a forecast." Markets drop 30%. Spreadsheets say you'll be fine. But in real life, panic might make you sell. So build a cushion for your money and your emotions. Save more. Expect lower returns. Avoid big risks that can wipe you out, like leverage. Even field mice once took out German tanks in World War II. No one saw that coming. You won't see every risk, but you can survive them if you leave space. Chapter 14. You'll change. Ever look back and wonder, why did I want that so badly? That's the end of history illusion. We know we've changed in the past, but we think we'll stay the same from here. We won't. People change careers, values, goals, sometimes after years of effort. The author's friend dreamed of being a doctor. Years of school, training, sacrifice. Then, he hated the job. So what's the lesson? Don't build your whole life on one fixed plan, because the person who made that plan might not be you in 10 years. Avoid extremes. Don't grind for money you might not care about later. Don't sacrifice joy today for a version of you that might never exist. Let yourself change. Walk away from goals that no longer fit. Flexibility isn't weakness. It's your insurance against regret. Chapter 15. Nothing's free. Who doesn't want a great investment returns, right? But there's a cost, and it's not just money. It's fear. It's doubt. It's watching your portfolio drop and still staying calm. Most people treat this pain like a fine, a punishment for doing something wrong. But that mindset leads them to sell at the worst time. Instead, treat it like a fee, a cost you choose to pay to stay in the game. Like a ticket to Disneyland. You pay up front because the experience is worth it. Want proof? The Dow Jones has grown massively over time. But it also spent years below its peak. Monster Beverage and Netflix skyrocketed, after crashing 80% along the way. Trying to avoid this pain is like trying to steal a car to avoid paying for it. You might escape once, but not for long. Volatility is the price of admission. Pay it, or you'll miss the show. Chapter 16. You and me. In the market, not everyone is playing the same game. Some trade daily, trying to make a quick bucks. Others invest for decades, aiming to grow wealth slowly. But when long-term investors start copying short-term traders, that's when bubbles form. Look at the dot-com bubble. Traders were flipping tech stocks fast. They didn't care about profits, just momentum. Their fast buying pushed prices way up. Then long-term investors jumped in, thinking, these prices must reflect the company's real value. They were wrong. When momentum faded, everything crashed. Same thing happened with housing in the 2000s. Flippers bought homes to sell fast. Prices soared. Then long-term buyers joined in and got crushed when it all fell apart. Here's the lesson. Don't let someone else's game ruin yours. So before you copy what others are doing, ask, am I playing the same game they are? If not, ignore their score. Chapter 17. The Seduction of Pessimism. Markets rise over time, but bad news always grabs more attention. Why? Because pessimism sounds smart. Optimism sounds naive. In 2008, a Russian professor predicted the US would break apart. Front page of the Wall Street Journal. But if someone had said in 1945, Japan will become a global tech leader, no one would have believed it. Even though it was true. Here's why pessimism is so seductive. 1. Bad news feels urgent. Money affects everyone. When markets crash, we all panic. 2. Pessimists ignore how we adapt. In 2008, people feared we'd run out of oil. They didn't predict fracking would change everything. 3. Progress is slow. Crises are loud. Heart disease deaths fell for decades. But one plane crash gets all the headlines. Optimism isn't blind. It's just betting that people will keep trying to make things better. And they usually do. Chapter 18. When you'll believe anything. In 2007, everything looked fine. Factories were running. Tech was advancing. Knowledge was growing. But by 2009, $16 trillion in household wealth vanished. Millions lost their jobs. What changed? Not the tools, not the talent, just the story. In 2007, the story was, "We're stable." In 2009, it became, "We're doomed." And that shift, just words, changed everything. We don't act on facts. We act on feelings, wrapped in stories. We believe things that feel true, even if the data says otherwise. That's why people chase miracle cures during pandemics, or throw money into failing funds chasing the next Buffett. Our brains hate uncertainty, so we fill the gaps with stories that make sense to us, even if they're wrong. That's the real game. And the winners are not just smart. They understand one thing better than anyone: human behavior. If this video helped, give a like and subscribe for more. Thanks for watching, and I will see you in the next one.